Well, I'm joined now by France 24's business editor, Cole Stangler. Hi, Cole.
Hey, Aaron.
You're starting with Netflix, which is continuing to grow, but not as much as investors would want.
Yeah, the company released its fourth quarter earnings late Thursday in the U.S. And to be clear, people are still very much signing up for the streaming service. Just over 8 million new subscribers in the last 3 months of the year. The audience drawn to big hits like Squid Game, Don't Look Up, both of which have already become these sort of cultural touchstones, if you will. But that number fell just short of expectations, which had ranged from 8.4 to 8.7 million new subscribers. And more importantly, it's really the forecast this year that's seen as underwhelming. Here's to get those numbers for you. Netflix says it's going to add just 2.5 million new subscribers over the first 3 months of the year. Again, that's a lot, but it's way fewer than what analysts expected. Also way fewer than during the same stretch last year. Clearly, investors not reassured by these numbers. Company shares down a whopping 20% in after-hours trading. And, we'll see what happens at the open, but the stock now on track for its worst day in a decade. One of the reasons why growth could be stymied is you have competition from other streaming platforms, sites like Disney Plus and Apple TV. There's also the ever-evolving situation with COVID, and company CEO Spencer Newman hinted at both of these factors when he addressed those results earlier today.
It's tough to say exactly why our acquisition hasn't, kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang that's still happening after 2 years of a global pandemic that we're still, unfortunately, not fully out of. While we can't pinpoint it or point a straight line when we look at the data on a competitive impact, there may be some kind of more on the marginal kind of side of our growth, some impact from competition, but we just don't see it specifically.
And Cole, Netflix is one of a handful of firms that boomed in the early days of the pandemic, but has struggled to keep momentum since.
Yeah, as we know, of course, the pandemic far from over, but government regulations are changing. Consumer behavior is certainly changing. And that's having an impact on some of these companies that did really well at the start of COVID, firms that basically benefited from the fact that you had millions of people staying at home, and companies whose share prices also reflected that. Things have changed over the last 12 months. That's clear for Netflix. Its shares have declined, even when you discount this latest drop. Over that same stretch, the last 12 months, Peloton, which makes stationary bikes, has seen its market value plummet. Just this week, CNBC reported it would also be pausing production on some of its bikes. There's just less demand for them. Zoom has also seen a drop as people are turning to in-person meetings as opposed to online meetings. There's also steep losses at Chegg, which offers online education services aimed mostly at college students in the U.S. It's interesting because the health situation obviously remains so uncertain, but consumers clearly not as interested as they used to be in these various stay-at-home products. Again, that's reflected not just in the earnings, but also in the share prices, which show how investors expect these companies to evolve. And maybe just to wrap up, Aaron, one exception to all of this is a company like Amazon, where we've seen share prices have declined slightly, but the company continues rapid expansion, sort of in a category of its own.
All right, Cole. Well, thank you for that business update.